Good evening, everybody, and thank you so much for coming in to this webinar. I thought it was a great idea to have a talk about investment properties and what's going on in the market at the moment. My name is Brett Davies. I'm a mortgage broker for the Mortgage Lab and have been for since the conception almost of the company. And I'm based in Auckland doing lending all around New Zealand. So maybe Rupert, we could jump into you and have a chat with you.
Yeah, so my name's Rupert Goff. I started Mortgage Lab just over 5 years ago. I am sort of the founder and CEO of Mortgage Lab. I also am the author of The Successful First Home Buyer, and I write some weekly columns for One Roof on various mortgage.
Garreth Collar from EpsomTax. Maybe we could hear a little bit about you.
Yeah, sure. EpsomTax.com was founded in 2008. So I'm the executive director of the EpsomTax.com group and the principal. We're investment accountants, so we specialise primarily in property, residential property, and that of course has several forms. That includes not only a traditional rental, but also things like Airbnb, boarding houses, and then we've also got a share of clients who are doing property developments and some in commercial. And in more recent times, of course, there's more and more interest in crypto and NFTs and those sorts of things. So under that banner of investment, we can advise on that too. But of course, tonight, the focus is property.
You're right. Thank you. Daniel Carney from Good Life.
Yeah, so I'm the owner of Good Life Financial Advice. We've been helping Kiwi mum and dad investors, if you will, for 23 years now to grow and protect their wealth. And I guess that's something that we're very, very passionate about, is helping people to, in a holistic way, so looking at all areas of their financial life to get them to a place in their, at some point in their life where they're financially independent, not reliant on the government or an employer or whoever for their income. But that's quite a journey. So our job is to help them map that out with the likes of you good gentlemen helping out along the way. To make sure that debt's structured correctly, they're in the right investments, they've got a plan, they're working to that plan, their estate planning sorted, etc., etc., etc. So when we say holistic, we mean holistic, and that's what we do, and that's who I am.
Great, thank you. Okay, so tonight's really, we've broken it down into about three main questions around investment lending. Hopefully everyone's got the opportunity to, or can see that they can ask questions. Please take advantage of that while we've got some experts here, and just fire those questions through as they come, as you wish. So maybe we'll kick off with our first question. So what has changed in the investment property market in the last 12 months? So maybe we'll start with you, Rupert, if that's okay, and have a chat about what you think.
I'm going to try and boil this down to less than an hour and a half, because there has been so much. I mean, the mortgage world from this time last year is completely different. We had LVR changes, which affected the investment property buyers down to 60%, maximum borrowing for existing properties and 80% for new builds. But then the real one that everyone will have felt, if they didn't even know about it, they will have felt it, was the Credit Contract and Consumer Finance Act, which came in the 1st of December, but was actually implemented by the banks a couple of months earlier than that. They wanted to show the Reserve Bank and the regulators that they were being responsible with their lending, so they implemented a lot sooner. Now, that brought in a raft of policy changes. In the last quarter alone, one of the banks made 38 policy changes to its lending, which is, I mean, usually we get 1 or 2 a month. And so there was just, you couldn't understate how much it changed the world of lending for investors. But essentially what the CCCFA did was it made the directors and the board of any lender personally liable. You couldn't opt out of your liability. You couldn't cover yourself with PI cover. And so if a lender was shown to be lending irresponsibly, they were personally responsible. And so this is where you find the difference between, say, the main banks, where the level of hierarchy, the number of staff levels between the assessor and the director is probably 7, optimistically, maybe more. So they have no control over those assessors. So this is why the banks have come down so hard on investors and home buyers. But talking about investors tonight. So if you're wondering kind of why, it's not the banks don't want to lend. They very much do want to lend, but it's they've had to change that. Now, along with that came inflation, and therefore interest rate OCR rises, and therefore interest rate changes. So the banks, as a result of that, put their servicing rates up, which is the amount that they stress test your mortgage at. And with mortgages, as investors with multiple properties and multiple banks know, the banks have to test all of your mortgages at that stress rate, and that is around 7.5% at the moment. So you've got to prove that you can pay off your mortgage at 7.5%, all of your mortgages. So in essence, it is a lot. It's a lot more finicky, the world of mortgages, as any mortgage broker will roll their eyes and tell you from their stress-induced position. But what the good side is that there's a lot less demand in the market, and I think Daniel's going to talk about that. But yeah. Essentially, the key one, if we had to pin down what has changed in the past 12 months in the world of mortgages, was the CCCFA, the Credit Contracts and Consumer Finance Act. That has fundamentally changed how people borrow money. It's going to change again, fingers crossed, in June, although June is not very far away, it would be fair to say, so maybe July. But the legislation is being pulled back to more like what it was prior to 1st of December. You're going to find it getting a little bit easier in the next month or two. So don't despair if you're looking to buy. It's probably my answer.
Yeah.
Brett.
Thanks, Rupert. So Daniel, from a financial advisor point of view, where do you see where things have changed for your clients, or what are people asking you that they're just they're worried about, I guess, with the changes that have taken place lately?
Yeah, my answer won't be anywhere near as long as Rupert's one.
Sorry.
So, from our perspective, one major change, which is pretty obvious, but it's the knock-on effect of that, is interest rate rises, right? But the thing is, we've always stress tested interest rate rises with our clients. It's just interesting that when they're actually here, like they are now, the reality of that has set in. So people are, what we've seen over the last 12 months is people becoming a lot more sensitive to that bottom line because of the higher interest rate environment that we're in. So that's really, and because of the CCCFA as well, those couple of things, people being more sensitive to the bottom line, as in what's it going to cost me to top up this property. Gone are the days of positively geared properties. We're well and truly into negatively geared land now. So we've seen a real sensitivity crop up, really grow exponentially over the last year in terms of people's affordability or feeling of affordability of that bottom line. That's and as well as the CCCFA maybe making borrowing a bit harder to attain, or the levels harder to attain. We've seen a real trend into more townhouses, people wanting lower borrowing capacity stock. So townhouses, terrace houses, stuff in satellite towns, not in the major centres, in smaller satellite towns. These kinds of things.
Sorry, Daniel. Are we seeing a different type of strategy and a different way of thinking around investment lending currently, do you think?
I don't know if different strategy, just more sensitivity, more people are truly understanding, because now it's not a future thing that has to happen in terms of, if we were in this kind of interest rate environment, you're going to need to fund X amount. Okay, but we're in that environment now. So when you settle, this is what it's going to be, and so people are a lot less, keen to do that. So we're seeing people wanting to look for properties that have a better yield, a rental yield. So, so that's been a big trend over the last 12 months. Is people moving towards. So I guess in terms of strategy, it's a higher rental yield strategy is becoming the norm. Obviously, new build property is a lot more popular as well, especially in the last 12 months because of the changes that have come in, and the taxation changes, which I'm sure Garreth will talk about. So new build property popularity has gone up. We're always pro new builds, but that popularity has gone up because of the 5-year Brightline rather than 10 years, the interest deductibility on the debt still being there. So that's pushed the popularity of new builds. We've seen prices consistently go up too. Yields haven't followed suit as quickly or as fast. So rental yields haven't tracked the price hikes in property. So that bottom line has grown, as we've said, and it's caused that greater sensitivity, as I keep saying. So we've seen those prices go up. Rents haven't gone up as quick. It's made the bottom line go up, meaning you've got to fund it more. Very recently, we've seen the falling away of FOMO. That's been talked about a lot. What I haven't really seen, though, because I've said that that's been replaced by FOOP.
Daniel, can you just
Yes.
explain those acronyms, whatever you're calling them, just for all of us that may not understand what you're talking about there?
Yeah, sorry, yes. Although that's funny, that's one that's been thrown around a lot. So FOMO, fear of missing out. We really saw a lot of that last year. That's really died off. But I haven't seen what they've said is replace that, which is FOOP, fear of overpaying. Well, I haven't actually seen that, to be honest. More just that I keep coming back to it, more that clients are just sensitive to that bottom line. Not so much, I think I'm paying too much for this. Can we get a bargain? Can we negotiate? We're not really seeing that, to be honest. And look, that's not really, the builders don't really do that anyway. So I'll come back to where things are going in the further question. But in terms of what we've seen, that's what we've seen from our perspective.
Yeah, great. Garreth, I mean, I'm sure you've seen plenty of changes from a tax point of view with rules that we have to deal with. So what's your take on all this?
Yes, that's true. There's been an enormous amount of changes to tax policy in the last 2 years, and that continued to accelerate in the last 12 months. Probably the biggest thing for investors has been the introduction of non-deductible interest. And so if you're buying a rental property now, which is not a new build and it is not rented to a community housing provider, then you can't claim the interest on it. In fact, anything that was bought after March 2021. So that's a significant disincentive. There are still investors that are doing that, but they're a real minority. So what those changes mean is that because new builds, anything which has gained its code of compliance or CCC after 27 March 2020, there's a few other little details there, but broadly speaking, anything after that date is classed as a new build, and then it has 100% interest deductibility, and for 20 years. So that's fantastic for tax. And it also means, in other words, it works like it always did in the past. It's just that these concessions were removed from just about everything else. And the Brightline Test period is 5 years. So typically, if you sell a property at the moment, if you bought a property today, it's going to be subject to a 10-year Brightline Test, meaning if you sell it within that 10 years and you can't claim an exclusion, you'll be taxed on any profit you make. This is the beauty of new builds, is that they have a 5-year Brightline Test. And often by the time they're built, maybe that takes 9 months. You could already be then 9 months into your 5-year period there without compromising your 20-year interest deductibility period. So that's sort of been a major change. Perhaps the only other thing that we could, or a couple of things we just comment on, is those that are renting existing properties to CHPs or community housing providers, they still can claim 100% interest deductibility. So we don't just mean Kaingaroa, formerly Housing New Zealand, but there's about 60 odd community housing providers in New Zealand that you can deal with there. So that's something. Not everybody's necessarily that keen on it, but if you're an existing property owner and it's starting to bite you, then it's worth examining that. Things perhaps that we would probably highlight a little bit later in our discussion are things like negative gearing. How does that still work? Losses carried forward, offsetting loss from one property against another, and so forth. But yeah, really interest deductibility, or gradually losing the ability over the next 4 years to claim all of the interest on your existing rental. For some, that's a game changer.
I just want to jump in there because the amount of interest, I think people underestimate how much it is, right? So if we look at a $600 a week investment property, which is $30,000-ish of rent, to pay tax on that, then all of a sudden is, what are we talking, say $9,000 of tax difference? So that's a remarkable difference, right? It's not a little bit of difference. The difference between a new build or after, was it 20th of March or 20th of March 2020 or something like that?
Yeah.
20th of March 2020. That is a huge amount of difference of yearly income for just one property, let alone multiple. So I think that's worth highlighting.
And maybe one thing I'll just comment is when ring fencing of rental property losses was introduced for the 2020 financial year and the 2021 financial year, at the time it was a real the scream moment, oh no. But those that had negatively geared properties and suddenly lost their ability to get a tax refund, i.e. you couldn't offset this negative gearing against your wages. Now you had a couple of years of carrying forward losses. Well, hello, we get into the 2022 financial year that's just finished in March. Now you've got probably a couple of years of losses to carry forward and offset at the same time that the government is gradually removing the ability to claim interest. So we assume most property investors, that pain is delayed, but sooner or later it will bite, unless there's some major policy change at a governmental level.
Yeah, well, aren't National saying that they will be scrapping a few of these things if they get into power next year? So maybe next year there could be a rewinding of some of the stuff. Who knows? But you can see why I was saying that clients are sensitive to that bottom line, because it's been the perfect storm of these tax changes and rising interest rates. And this has just created a stampede towards needing higher yielding, lower priced properties.
Take this webinar down a political discussion.
Oh yeah, no. I wasn't wanting to do that. Definitely
Quick,
not.
Brett, get us out of this.
Question who?
Okay, so right, let's move on. No more politics. So what do the next 12 months look like for investment in the investment property market? So maybe Daniel, you might be able to kick us off here, because you're dealing with this type of thing on a daily basis. So where are you? And what are your thoughts here?
Yeah, well, next 12 months, similar trend to kind of what I was saying with the last 12 months in my first answer. We're going to see a greater demand for property at that lower price point due to the higher interest rate environment that we're in, and the effects of the CCCFA on people's borrowing capacities. And hopefully some of that gets rewound as well. But these lower price points attract a higher rental yield, which is where we're seeing all of the demand, or a lot of the demand. I can't see that that's going to slow down. People are absolutely on a hunt for rental yield. So that's going to continue as the next 12 months ticks along, for sure. Interestingly, we haven't had one client mention their concern around house prices going backwards, even though our good friends in the media talk about that. I'm glad that we haven't heard that yet from clients, because really this has been experienced more, I think, across the major cities and towns in New Zealand, in the centres. Those existing properties in the centre of the cities and towns, excluding, of course, Canterbury. They're out on their own there. I can't see a sustained drop in prices continuing. This is merely a small correction because we've had those insane hikes for such a long time. So this is, it's not necessarily a bad thing. It's almost impossible that we see that same trend of, going off the Boyle property values. I think it's impossible that we'll see that same trend hit new build properties, because land values are not going backwards. If anything, developers are putting land prices up, or land prices are going up. And it doesn't take a rocket scientist to see and understand that building costs or materials for buildings, for building, are going up. They're creeping up because of inflation. So that's pushing those prices up. That's irreversible. So I don't see prices dipping in relation to new builds. Perhaps the stock won't be flying off the shelves as much as we've seen because of that fear of missing out factor. So that means less competition, which is a good thing for investors or buyers. But as I say, I can't see house prices going backwards for new builds.
Do you see?
Sorry.
Sorry. Do you see more? I think we'll see more turnkey type contracts based on this, right? I mean, surely, because the banks are not really keen to look at. They want fixed price contracts, right? So they don't want to see a whole lot of PC sums or whatever in those contracts. They want to understand that they've got some certainty in the price that the client's paying for that. So
yeah, you're right. Actually, that's something that I hadn't thought about, but we are seeing definitely a trend of people asking for fixed prices, or even banks fixed prices or turnkey contracts. So and that makes sense. And I was talking to a builder today. They're not even pricing to put on the market some properties in a very popular area. Been very popular with our clients. They're not even going to put them out there to the market yet, because the titles are too far away, and they're too nervous to put a dollar figure on the contracts yet. So hopefully that means that when we do get to that point, that's going to be a fixed price. But that's a movement we've seen definitely with the builders, where they're chopping out PC sums where they can, and making these prices as fixed as possible. Yeah.
So we have seen some change in bank policy regarding one particular bank regarding what's the word, Rupert, that I'm looking for?
Cost overruns.
The cost overruns and have gone up. So that adds extra servicing issues for lending.
Yeah, I just saw that today, actually, that very subject, actually. Yeah. So just on another subject, in terms of interest rates, I don't see. Be interesting to see what you gents think about this, but I don't see much more upward movement in interest rates, because banks have said anyway that they've already largely priced in the OCR projections and hikes, or to come, that haven't happened yet. So they've already priced them in to a large degree. So I'm not too worried about rates going up much more than where we're at now. They might creep up a bit more, but I don't think we're going to see them go up much more than where we are now. So in terms of the next 12 months, I don't see a huge difference to where we are now in terms of interest rate situation. So yeah, that's my take on what's going to happen in the next 12 months.
What do you think, Rupert? Interest rates?
I would tend to agree. I think the 90-day bill rate, which is what the interest rates for the banks mainly priced off, have factored in the OCR rates. The OCR will continue to rise. unless something really gnarly happens with inflation, that's going to be stable. So I would tend to agree. I think I always use the 1 year rate because it's the kind of one that everyone follows. It's the cheapest, and kind of everyone follows that. I wouldn't be surprised to see a 5 in front of it, which is kind of 0.5% above where it is now, but a real low 5, right? So we're not talking that jump that it's done in the past 9 months from 2.1 to 4.5. We're not going to see that again. That would be crazy times.
So we're seeing interest rates where they were probably 4 years ago? Would have been about these sort of numbers.
And people were happy about it. People were amazed when it got to 4.5. But look, the house prices have gone up, so I understand.
Yeah, lots of other changes as well. Rupert, what about
12 months in the next
12
investment
months,
property market?
Yeah.
So as I mentioned before, the lending is going to get easier. Would be my guess. The legislation around the CCCFA is going to get clearer for the banks, so the banks don't have to do things like, and this is the classic one, right? The Kmarts and the avocado on toast. If you've been buying too much at Kmart in the past 3 months, the banks have always understood that you're going to stop that. You're going to prioritize your investment property or your current mortgage over luxury spending when you have to pay your mortgage. But at the moment, they have to take that into account. So that is going to be redone. You're going to be able to forecast your expenses a lot easier, and that is going to bring in a lot more it's going to free up the finance, which is going to raise demand. But I think there's so much at play here, right? Because to Daniel's point, there is going to be, and Brett's point, there's going to be a lot more turnkey contracts out there. This will bring in a different kind of developer. So a developer that does turnkey needs to fund the whole development. If it's a $10 million land and build, they need to fund $10 million plus of interest to build it all. Whereas a progress payment one, they just need to fund a section, then the customer takes a section and they just have to fund whatever stage of the build they're at. It's going to be quite a different developer world. But in terms of how that affects you as an investment property buyer, probably minimally. You're just going to see some shift in that market. But the good news is that lending will, I think, imminently change for the better. When that demand kicks in, the Reserve Bank's going to try and stop properties going on a runaway tear again. They don't want to see another 30%. Nobody wants to see another 30% rise. So that could be, and I am not going to put a large amount of money on this, but that could be in the form of LVR changes, and it will be to investors, would be my guess, because no government coming into a election year wants to look like they are hurting first home buyers. So I wouldn't be surprised if either they took away the exemption rule, the LVR exemption rule from new builds down to 60%, or made that 50% as a rule. So it's not currently that. Remember, it's 60% for existing, 80%. Actually, it can go way higher for investment property. We've seen 90% for investment property. New builds, just watch them playing with that, because they don't want to play with the CCCFA. That's a terrible tool to stop borrowing. DTIs, I think they're a terrible rule again, but also, and so LVR are kind of their thing. That would be my prediction.
Yeah, well, we've seen some DTI reversal, right? So already this week. So it's not so much of an issue at the moment for us.
Yeah, only one bank has it now, and it's kind of a real kind of background policy. It's more of a filter than a policy, really. Yeah.
So just to explain that, DTI is what?
A good point. Yes, I've done my own
Brett's game here.
Debt to income ratio. So you typically, they might say you can only borrow 7 times your income. If you're in 100,000, 700,000 is your maximum borrowing. I could go on for about an hour on why it's a very stupid rule. It involves student loans, it involves interest-free loans. Just don't get me started. But it is a tool that the Reserve Bank were investigating. LVRs are a much more efficient way of controlling the heat of the market.
So Rupert, do you think, in your humble opinion, that they're less likely to use the DTI stick, but more the LVR stick, you think? Because I haven't seen them talk, well, I've seen them saying that they could bring in stricter DTIs or enforce them. So do you think there's a higher probability about messing around with LVRs again?
Well, I think they're going to try with DTIs. I would strongly back a move against it because they are. Think about a doctor, right? A doctor would have a $200,000 student loan, so that takes, and yet they've got large potential earnings, right? But may not be earning so much. They're a brilliant candidate, but their student loan is stopping them from getting the mortgage they rightly deserve on their income. So. Yeah, I believe they're going to try it, and I believe it won't work.
Right.
Hopefully, who knows? There might be some doctors watching this evening that just suddenly got concerned about that, and they could spread through the medical community like wildfire. Yeah.
Well, Gareth, do you want to take us through to the end of this question regarding what the next 12 months look like? I mean, for you, do you see anything significant from your perspective?
Yeah, well, as Groucho Marx says, I'd like to take up the tax. Actually, I'd like to take up the carpet, but you have to take up the tax before you can take up the carpet. So that's, yeah, I love the Marx brothers. So you're talking about taxes. How will it affect investors? At least what we're seeing is that most people have got some losses because a lot of property was negatively geared historically. And what I mean by that is it was designed to run at a loss. The income was less than the expenses. The loss would generate a tax refund. And then as it's been taken away over the last 2 years, these losses, they're not lost. You don't lose the loss. It gets carried forward to the subsequent year and so on until you've got some more rental income to offset it against. So that means the impact for most people will be delayed somewhat. The interest deduction changes kicked in for FY22. So it's the financial year, 2022 financial year, which just finished about 6 weeks ago. So from October last year onwards, you could only claim about 25%. You could only claim 75% of your interest on your mortgage. So effectively a 12.5% haircut on the interest for the last year. And then this same 75% effect is going to carry right through this year. And then once you get on to the next financial year, so that starts April next year, it's going to increase. You can only claim 50% of the interest, and the following year only 25%, and then the following year 0. And so some of us know what it's like to have a very severe haircut. It's not pleasant. Yeah, although it is quicker. There's less air resistance. So in this case, though, there's not a lot of real benefits for investors. They just see the value of that being watered down. So the question is, should you sell your existing property? And the answer is it's not a simple answer to that in terms of what the next 12 months should look like, i.e. a couple of scenarios. If you've got some losses in your portfolio from past years, you can offset those. We'd say at the very least, wait till you've used up the losses. You need to consider would the investment property be caught by Brightline. But if you waited another year, you might have to pay a couple of grand tax, but it means you might sell the property, make $250,000, tax-free capital gain. So that's a pretty good investment if that's the outcome. We've seen probably in the last 2 years an increase in clients that are selling properties. Most of those, though, have sold those to buy a new build, which is what the government policies were encouraged to do. We're trying to encourage anyway. The other thing, too, though, is given the interest, the changes that Rupert was commenting on earlier, investors need to just take care a little bit, because you might think, oh, well, we'll sell our property and we'll cash up and we'll pay a bit off our mortgage. Great. And then we'll just buy another one and rinse and repeat. Great. But your borrowing capacity is probably likely very much reduced from what you could do 5 years ago. So this idea of, oh, we'll do this and that, and sounds good in theory, but in practice it might not be. So it's essential to first check, well, these other tax issues we just mentioned, or any Brightline issues, etc., the borrowing capacity. Talk to your mortgage advisor, your financial advisor about that, like the Mortgage Lab, of course, and just make sure that this idea, this brilliant idea you have in your mind, is actually going to be achievable, or you're going to need to pull that back a bit. And then the other thing to consider is, look, if you had $100,000 in the bank, what would you get on it in interest and term deposits? Something miserable. Even as a point of comparison, I bought $500 worth of Tezos, which is a cryptocurrency, a few months back. Well, because of what's happened in the share market, that Tezos is $320 worth now. And I looked at the returns on it. If it stays at $500, well, maybe you'll get 4.5–5% return. That's better than the money in the bank. But it's dropped, and probably it will recover. And we're talking, a long-term strategy. But the point in mentioning these things is, sometimes it might end up that you start to pay a bit of tax on your property because you've used up all your losses, or however it's structured. But if that costs you $50 a week or $100 a week, what would you get with that same money in the bank, in term investment in crypto, even in shares? Probably not as good a return. So sometimes you just have to suck it up, hold it for another year or two, wait till things just pick up a bit, then think about selling it, rather than just rushing in and trying to cash up. So it is very much proceed with caution, and every situation is different. So what your friend did at work, or what your neighbor did, that doesn't mean that it's going to work for you, because there's no end of armchair experts, usually friends who have well-meaning advice. Oh, you should do this, but do they have any experience? Do they have any qualifications? Are they dealing with this every day, or are they just another armchair expert? And the fact is, all of us, we carry things like PI insurance, which was mentioned before, professional indemnity insurance, because there's comeback on the advice we give. But your mate, as much as they love you, there's no comeback. You just maybe might not talk to them for a while, because you took their advice and lost $100,000. So the point of that long ramble is, every situation is different. Don't rush in. Make sure you get qualified advice from the sort of people that are in this webinar this evening.
It's property is always a long-term game, right? That's really what it comes down to at the end of the day.
Very much.
We've got to ride out. At the moment, we're going through this bit of drama. A year or two back, everything was very nice. Interest rates were low, prices were rising. It was great, but we just have to. It's a cyclic thing that we go through, right? And this is the down. But,
to borrow a crypto expression, hodl, hold on for dear life.
Thank you. Rupert, have we got, by chance, anyone asked us?
We haven't had any questions come through yet. So
Well, can I? Yeah.
We've covered everything.
Respectfully ask anybody who's out there what they've got anything they want to know. There's no silly questions. Please just ask us. We've got a whole bunch of people here that know what they're talking about. So please just type away and ask something. Okay, so let's motor on. Anything comes through, Rupert, I'm sure you'll stop us to. Yeah. Okay, so the last question that we've got here is what should be considered when buying an investment property at the moment? It's really who wants to jump in here?
Should have
Could I talk a little bit about structure, perhaps?
Yeah,
as a place to start. I think Rupert and I were actually talking a while ago about, there was a time when you could probably do your maybe your sole trader rental, follow the ID books and get it probably mostly right. What's happened though is, with the complexity of laws, timing of code of compliance, interest that is deductible from certain points of view, and don't even go down like if you're trying to do some sort of development. That's another world of technical pain. Getting everything in the right place has meant a lot of internal education for our firm, and our people are doing this stuff, you know, all day, every day. I've looked at the new tax returns for the 2022 year, started working on filing some of those myself, and especially for trusts. It's just got very, very complex. And so that sort of side of it, that's got a lot harder. And ensuring you don't end up with some kind of stupid mistake, because I say stupid, innocent perhaps, but the law doesn't allow for innocence or for good intentions. You got it wrong, too bad. That's just how the law is most of the time. So we think it's got a lot more risky. And look, this is somewhat self-serving. It sounds like coming from me, hey, we've got a lot more risky. You should get an accountant to do your accounts. So it would be good to hear the comments of of Rupert and Daniel on this. But the risk level is certainly increased because the complexity has increased tenfold. I've never seen this level of complexity in all the years we've been doing rental residential property tax. So I think that's kind of one of the first things is, educate yourself as much. If you want to buy an investment property, absolutely, get the New Zealand Property Investor magazine, look at joining groups that like the Auckland Property Investors Association. Obviously follow Mortgage Lab, Good Life, EpsomTax.com on social media, all that stuff. That'll all help educate yourself. But probably the days of DIY rental investment are gone.
I would agree. I think as we spoke about before, the cost of doing a mistake. So in the oldie days, you might have claimed some petrol and you shouldn't have claimed some petrol, and that mistake cost you a couple of $100. Whereas I think now we're into the big numbers when you make a mistake, and that's something worth thinking about. Do you want me to go, Brett? MC, Brett?
Can I just
go, Daniel?
I'm good.
No, I'm not going to ask. Well, I am going to ask a question. I just had a lovely, loyal, long-term client of mine text me, actually. I have my phone here, just in case. And he's saying he can't ask questions on the webinar. He can only see a screen with the four of us. So is there a special way to ask the question? Or can that maybe just be emailed or something?
Why don't we come back to an email? Right. We'll email it. I may not have turned it on.
Oh, okay. Good times. Okay.
Yeah.
All right.
Okay. Can I just jump in here? Okay. No, I'll come back to the genuine go if you like. I just need to find a solution.
So, sorry, say that again.
That's right. I'm mumbling.
You go, Daniel. Tell us about
Daniel.
So
what to consider.
Yeah. Okay. Cool. Well, there's. Yeah, I say this quite often to people. There's a saying. Well, you could say, when is the right time to buy an investment property? And my response to that is always now, right now. Now is always the right time to buy an investment property. Whether that now was 2 weeks ago, whether it's tomorrow, whether it's in a year, the main thing isn't about timing the market, it's time in the market. So really what people should be thinking about is getting advice, actually. Getting quality advice from the right people, understanding the structures, and that structures around the debt structures, their cash flows, the risks, the investment property structures, best and worst case modeling, all that stuff. Figure all that stuff out, and then if it works, and if it works for you at that moment, then get in, set and forget, and hold and hold that for the long term, as we've talked about. I think we're all kind of on the same page there. We're not here to be speculative with our clients. We're looking to to grow long-term wealth across multiple asset classes, but property has been the rock star over the years for many reasons. So, it's a 10-year plus recommendation. Get in, set it up correctly, get the right advice at the front end to find and analyze that property, and the right advice at the back end to look after it. And mainly that's your Garreths of this world and property managers. And you just get on with your life. So, we did a video about this, I think, once before, Garreth, in terms of, it doesn't matter what events are playing out at any given moment, and this is we spend a lot of time talking to clients about this, removing the emotion from the mix, being as unemotional as possible with this process. So it doesn't matter. I mean, of course, these are not great things that are happening, whether that's high inflation, rising interest rates, a war in Ukraine, whatever. Anything can be played. The Herald just said that house prices in my neighborhood have gone down 20%. Who cares? It doesn't matter about that stuff. We're not investing for those reasons. We're investing for beyond those reasons. And historically, you look at any major events that have happened, they happen, and then there's corrections that happen after that, in terms of upward corrections. So what we're mainly concerned with is, can you do it now, and can you stay the course in the best and worst case scenario? So that's risk management, that's risk mitigation, that's stress testing, fully understanding everything, and hitting the go button, getting that right advice. And so we want to stress that to people, to get the right advice, understand what they're getting themselves into, understand the risks, understand how to mitigate them and manage them, understand how to not leave thousands of dollars sitting on the table that you didn't even know was there. DIY, Kiwi way of doing things. I think we talked about that once, Rupert, as well. Long gone is this space being favourable to DIYers. You really need to be in with really a network of people who know what they're doing. And that's not saying that to sell what it is that we do here. It's just there are huge mistakes that can happen, and I've seen them so often over the years with people before they've come to become our clients. But importantly, having this all in the context of a proper strategy. You're not just blindly going out there and buying an investment property. You understand what it means to your financial position now and into the future, and to your long-term goal of where do I need to get to be financially independent? Like, what's my target, and what's this doing to help me get there? So you're putting property into the context of an actual plan and strategy. So, in short, yes, it is always a very important consideration to be buying residential investment property, if you can do it. Get in, stay in, set and forget. And hopefully it's been loud and clear from this webinar to do it the right way and get advice from the right people.
Excellent. Okay. So we've had a bit of a drama tonight. We've obviously got
the least of all the dramas.
Okay, so here's if anyone's got any questions, we've got 10, 20 minutes, whatever, to go. If we can hang in here for as long as you like. brettd@mortgagelab.co.nz. If anyone wants to email me something, so that's brettd@mortgagelab.co.nz. I do have someone who has actually emailed, by the looks of it, both of us, Rupert. This is for you, Garreth, I believe. Last year, I remember hearing that IRD was going to change the rules so that if we move a property from personal ownership to a company, it wouldn't reset the Brightline 10-year. Do you know if that rule change was implemented?
Yeah, okay, that's a good question. Thank you, caller. I've always wanted to say that. Yeah, that's an excellent question. Yes, the law change was debated and passed at the end of March, and it took effect from 1 April this year. It's called rollover relief, that legislation. It doesn't allow changes in all directions and with all entities, but quite often changes that involve moving from trust to personal names, or LTC even to personal names, there is also some comments about movements between LTCs and trusts. So there's some particular hoops to jump through to make sure that you don't get caught. So that's where the devil's in the detail, like in a lot of things. For example, if you're transitioning a property from your personal name into a trust, then you have to be a settler, and the beneficiaries have to be within, I think it's 5 degrees or 4 degrees. And there's various things like that. So it's one where time has to be taken to make sure all I's are dotted and all T's are crossed, rather than all I's crossed and T's dotted. So that's one thing. The other thing to consider is, at the moment, and they've got to fix the law, and they've said they will, if you had a property, say, that was bought in 2016, you transferred it into another entity using this rollover relief, it would actually be subject to 10-year Brightline, technically speaking. And that was not the intent of the legislation. So that would mean there's no reset of the Brightline test, but a 10-year test applies. Now, IRD have said they're aware of this glitch. It wasn't intended. They will fix it at the next time that legislation is passed, and that's likely to be August. But in a couple of these situations here, we're sort of saying it ain't happened yet. They've said they'll fix it, but maybe it's better to wait until then. So it does depend on the timing of when the property, when an interest was originally acquired in the property. That's a factor. So there's just a little gotcha about that as well. And look, this is what's happened over the last several years, to be honest. I guess Parliament has said to IRD, we want this, make it happen, make it so. And so it's sort of in a very Star Trek way, they've had to kind of rush through stuff to try and meet political deadlines, I guess, and stuff gets broken, or things are not properly written, or there's unintended consequences. It happened time and time again because of these tight time frames. So I'm not sort of saying, oh, IRD are evil here. That's just probably a consequence of the pressure that they've been put under to try and produce the goods in the desired timeframes. So short answer, yes. Long answer, proceed with extreme caution.
Thanks, Gareth. So I've got something else for you. Thanks, Gareth, listening in. This is your question. If you, understand interest expenses remains tax deductible for 20 years and is transferable to new owners, what is the law around the 5-year Brightline? Sorry, what is the law around the 5-year Brightline? Is that only for first purchaser post CCC, or can it be transferred? That was a mouthful. Did you get that? Do you want me to read it again?
So the question is, the first purchaser gets a 5-year Brightline. What does a subsequent purchaser get? Essentially, yep. Do they also get 5-year Brightline?
If they sold it after 6 years, they would still be tax deductible because within that 20-year period, would they still have the 5-year Brightline?
My understanding is yes, but actually that hasn't come up, so I better double check that question. I believe the answer is yes, but I'll have to double check that one. It's probably worth noting that there's, as with any new law, and we saw this when LTCs were introduced, look-through companies were introduced, they were not a thing, and then they suddenly came in. There was lots of stuff that, hey, nobody thought of that. IRD didn't know. So there is sort of a lot of these kinds of questions being asked that we're still having to finalize or find the answer to. And I guess just why? Well, the most recent document was 216 pages of single-spaced information. So it takes a while to read through and get all the details of that. But that's a good question. I will just look for a bit of clarity, and we'll post something on social media about it.
That's okay, Gareth. This is Phil. Answer that question. Sorry. I'm going to email you that so you can respond, if you like.
Yeah.
As well as put it where you like. Interestingly, I've got some more questions, so thanks everybody for emailing me. BrettD@mortgagelab.co.nz. Thank you, Rupert.
I did wonder why 200 people weren't asking any questions.
That's it.
Yeah.
Anyway, we'll talk about that tomorrow.
Sure, we can review that.
Daniel mentioned that investors should have a network of people who can provide professional advice. My question is, who should you have on your bus? Accountant, financial advisor, mortgage broker, who else, and how to find them? Really good question, actually.
The question for me?
Go on.
Was
then.
it?
Yeah, well, I think it's pretty general. I mean,
Oh, sorry, I thought you said Daniel.
I did say Daniel because, you're
not reading out the full names and addresses of the people writing in for these questions, are you? That's privacy.
First name only. This is Trent. But the thing is that you are a financial advisor, and specialise in this area.
So a while ago, it was Kevin Smee, and I'm pretty sure it was in the Herald. He actually had a very good analogy for it. He likened your you could say, sorry, Rupert, I thought you were laughing at me. He likened your network to like a board of directors, right? For your family business, right? And that's, as you say, it's a good accountant, a good lawyer. You notice I say the word good. Good accountant, good lawyer, financial advisor, investment specialist, a good mortgage broker, a good risk specialist, insurance person, and if you're investment property, a good property manager as well. I'm trying to think if I've missed anybody out. Maybe a good cash flow management person too, a la Linda Moore, money mentalist type person as well. If you really wanted to have the greatest board of directors around you.
The dream team.
The dream team, yeah. So, look, just putting my 2 cents in here. If it's an accountant, make sure they're an investment specialist. And if you're in the investment property space, they're an investment property specialist accountant. I'll stop myself there. If they're a lawyer, they're a good communicator. What I mean by that is, contracts aren't perfect. And sometimes they are written in the favor of the builder, maybe. Just because that's a fact, it doesn't mean it's World War III. It's not an ego competition. It's let's get to a position of middle ground that everyone can live with. So a lawyer that can help that process along is worth their weight in gold, I think. A good property manager who knows the market, knows the right rents to be advertising and achieving, not overstating rents or understating rents. That's important as well. And mortgage brokers, I don't know if you like being called a mortgage broker or mortgage advisor or mortgage specialist, but someone that knows how to structure the debts correctly, interest only versus principal and interest. That's really, really important because all of these people work in harmony with each other. And like a financial advisor as well, giving investment advice, it all works in harmony. What debt to be paying off in the right order. So I think not only is it good having the right people around you, but the people who are around you click with each other as well. They know and respect. Well, not necessarily know each other, but they respect each other. They're not butting heads, and their advice gels with each other. And basically, to sum it up, they're all there to grow and protect the client's wealth. They are all there to do their part to grow and protect your wealth, and they should all be working in harmony to do so, not fighting amongst each other to do so. So that's my 2 cents about having the right network around you or the right board of directors for your family business.
Well said. Okay, I just got another question. It's going to be there's 2 parts to this. Thank you, I think it's from Min Lee. What are the benefits of owning a property in a LTC trust or company these days, as it seems to be getting more complex compared to in your own name? So that's the first question, Gareth. I think you might as well.
I love it. I'm loving it.
Yeah, okay, they are good questions. Okay, so maybe let's just talk about tax minimization and a little bit on risk minimization as well. So in terms of maybe why you might use a trust, trusts are a very flexible entity. They can distribute income out to the beneficiaries, and that's fantastic in terms of if there are beneficiaries that are on a lower tax rate. You can't distribute much to your children, only about $1,000, and then they get taxed at the 33-cent rate anyway. So that is if they're minor children. So that's kind of if you've got a cash flow positive rental property, in other words, it's making money, and you do have beneficiaries that might be a spouse that's on a lower income, then there are some tax advantages to be attained from distributing income to them, no questions asked. Although IRD is wanting to know more about it, they have attempted in the past to argue that the trustee's decision to distribute money to beneficiaries is sort of borderline tax avoidance, and that's been struck down in the courts. Why some choose to also use a trust, and this is more a lawyer discussion, is because it takes property out of your personal hands. When you own it yourself, when you hold the shares in a company, whether it's a standard company or a look-through company, you own it yourself. So therefore, it is exposed to a certain degree. Any sort of attempt to separate guarantees by banks, as soon as you sign a personal guarantee, forget it. Everything you've got, almost including grandma, is now the bank's. So that's sort of one thing that sets trusts apart from other entities. Standard companies, i.e. they're not look-through, just a limited liability company. Look, if there's two people buying a property and they're both on the 33 or the 39-cent tax rate, let's say it's cash flow positive, so it's making money, it might be worth putting it in a limited liability company, and it pays tax at a flat 28 cents in the dollar. So now you've got a 5% saving, or even more if your salary is 180K plus a year. So that's a scenario where that can be useful. Look-through companies, well, look-through companies function pretty much the same as a partnership at tax time, and the income or losses are distributed out according to how many shares you hold. One scenario where a look-through company is still useful is this. You own your own home, there's still a mortgage on it, and your rental property is negatively geared. In other words, you have to top it up a bit each week with cash. Well, what that means is you're effectively lending money as shareholders to your look-through company. Now, over the years, that can add up. Let's say 5 years go past, you've lent, I don't know, $50,000 to the look-through company. Well, now that company, in effect, can go to the bank 5 years later and say, I need to repay the shareholders. The value of my rental's gone up. Can I have $50,000? The bank will then lend that money, assuming it's a new build. This is going to be tax deductible, because all you're doing actually is switching borrowing from one lender, the shareholders, to another, the bank. It's not new lending. You take that money and you pay it off your own mortgage on your residence. So in that scenario, what you've kind of done is your overall debt stays the same, but you've dropped the debt on your home by 50 grand, increased the debt on your rental by 50, and you can claim that interest. So knock down bad debt, increase good debt. You can do that with a look-through company. You can't do it with a partnership. You can't do that if you buy it in your own name. So we don't automatically say, oh, thou shalt set up a look-through company. There's specific scenarios where it's worth doing that. There's other scenarios where just keeping it simple is better. And lastly, if you're a single person, then 9 times out of 10, you are better to just buy it in your own name as what IRD would call a sole trader.
Great. Thank you. I hope that answers that question for you, Lee. Second one is, what have your clients' experience been in renting to social housing? I do have some clients in this situation.
You got that one, Brett.
Generally, there are some benefits from that. The people who are leasing the building are going to repair the building at their cost. So there's some benefits there. So there's no cost to the client if that is built into the contract. Daniel, have you had any experience there?
We haven't got a lot of clients that have gone down that track. We do have one who has leased theirs to the Salvation Army in Hamilton.
Same. I had the same thing.
Yeah, I haven't heard any issues whatsoever. In fact, I heard that there were a lot of empty rooms in the property, yet they still had to pay the full rent. And as you said, they'll cover any costs whatsoever. So it's there's no property management, there's no real maintenance charges.
Guaranteed rent, I guess.
Yeah, guaranteed rent.
For the contracted term, it might be a 5-year term in there or whatever. So there are some, I guess there are some.
There's some, Garreth knows these companies only too well as well. There's some really well-run private companies out there, not poo-pooing Kāinga Ora, but there's some well-run private companies out there that you could talk to pick their brains about if you want to look at that as an option, and if it's a consideration for getting the tax deductibility, especially. They're good people to talk to, and they're private businesses, so they're read between the lines.
Garreth, have you got clients in this situation?
Yeah, we do. The experiences with community housing providers or CHIPs generally tend to be good. The experiences with Kāinga Ora can be like any government department. The wheels turn slowly. So they're not alone in that. And the feedback we've had has been consistently good in dealing with community housing providers. Unfortunately, we haven't been able to say the same with those who've dealt with Kāinga Ora. So you do just need to really go in with your eyes open if you decide directly to engage with that government department. And from what we hear, it may be less stressful to engage with a community housing provider. As you can tell, I'm just trying to be tactful there, and apologies to anybody
That was great.
At Kāinga Ora. We know you're public servants and no doubt working hard for the good of people.
Okay, I'm going to slowly wrap this up. So let's have a bit of a recap. I think we've come to the conclusion, though, that investment lending is still an option, right? There's no doubt about it. And we're doing plenty of it still. I know personally that I have many clients who are investing in property and continue to inquire about that. And I know, Daniel, you're the same.
Mm-hmm.
Rupert, what do you think? I mean, from what you hear and the one roof side of things and all that.
Yeah, I mean, there's a lot you need to keep up to date with. I think the clear indication from this webinar was, new build is the direction to look. You're going to want to think about cash yield. Have a think about how the banks treat individual parts of the property you're buying. So how they scale rent, how they scale the income because it's a newer property. Have a think about all those things. But at the end of the day, there is less demand, so there are bargains out there. There are some developers who are having people not settle, so there is actually bargains out there now for people that signed up 18 months ago and now don't fall under the lending criteria. It's worth shopping around, I think, would be my wrap up.
We do have to be mindful in that situation with on-selling, as far as the banks see new builds as an on-sell.
It wouldn't be classed as a new because you're not buying it off the developer. You'd have to buy it. They would have to fail the transaction, give it back to the developer. Developer then sells it. Yeah, that's a great point to make, mate.
quick wrap up for you, Garreth.
Yeah, actually, just a thought there on that new build. Conceivably, if it's being bought within 12 months of the code of compliance being issued, you might still be able to jump through a hoop. And I haven't come across any of those situations. But again, a lot of these that you're talking about, hypothetically, you know, it falls over, and some of these things you've got to kind of check out the detail.
LVR exemption from the bank, it needs to be directly from the developer.
Oh yeah, I'm thinking tax, of course.
Yeah,
you know, like borrowing, that's not our problem.
Yeah, the Reserve Bank is within. I know, I wish that uniformed all this, but within 6 months of the CCC, directly from the developer.
Wow, interesting. Okay, I think this underscores that point alone, why you need a good team around you, not all in each other's pockets. Like, we quite often work together. We don't always agree with each other. We're able to disagree about things because the client's at the center. So I think that's the thing. It does sort of unnerve me a little bit where, come to us, we'll do everything. It's all under one banner. Well, where's your accountability and who's keeping each other honest, you know? So that's sort of, I think, the thing when you pick your team, as Daniel had outlined before. And my only other comment would be, watch out for paralysis by analysis. It's an ongoing problem where people they don't do anything because they overanalyze. There's a balance to be attained between being informed and just stalling. And we had one set of clients years past, 4 years. Finally, they got into something. Had they gone with the recommended financial advisor who happened to be Good Life Advice, they would have been 4 years ahead in that whole property market. It was just, we're happy they finally got something. It was just tragic. It was just an unnecessary waste and stress in 4 years. So there are times to DIY. Great. You know, yeah, I'm digging out fence posts at the moment at home, but the builder's going to finish off the job. So know when to get the builder in.
Okay, thank you. Garreth, I'm sorry, Daniel, any final words of wisdom from you?
It would just be mindful of your future. You know, the largest majority of New Zealanders get to retirement dead or dead broke, unfortunately. So understand and get advice and understand where you need to be to not be so reliant on having to turn up to work every day. And then whatever the right journey is to get you there is the right journey to get you there. And hey, we're pro property because because in New Zealand it's just quite a microclimate for that being a good opportunity for people. But it's one part of an overall diversified portfolio. But I think the major thing just comes back to get advice, and hopefully if anything, this has either kept the people who have joined this or are watching this to stay the course, or to reach out and get advice, because we want to get as many people out of that majority that are going to have a pretty tough retirement, into the minority who have actually gone and sought advice from a good group of people. So that would be my closing comments.
Nice. Hey, okay. I think we'll leave it there. And thank you everybody who's jumped in today, especially our Rupert, Daniel, and Garreth. Thank you so much for your help. If anyone wants to know anything further, got any further questions that they want to ask, please just email us. You can easily track us down at mortgagelab.co.nz. I will pass on anything that comes through, or Rupert will, to Daniel or Garreth. And we're just here for anyone who needs assistance, or help. So thank you so much.
Thank you very much.
Thank you.
See you guys.
See you later.